Well, I think the big question is, right, it looks like we are going to get some deals done, according to President Trump. And as we're recording this, we're going to have some big, beautiful deals done. But I think the wild card here is China, right? It doesn't seem like China is willing to play ball at all. And I get the fact that they sell us a lot of goods. And I get the fact that their economy basically is exporting goods, right? That's what they're relying on. But they have one inconvenient, I guess is inconvenient for the Trump administration, is they don't have to worry about democracy. It's a little easier when you don't really have to worry about what the public thinks of you. Whereas here in America, as you know, I mean, the world right now is on fire here in the U.S. because we need to do business. We need to do it yesterday. And let's face it, I mean, it is a democracy. And President Trump, he's only as good as his last decision or last move. And he's feeling the pressure right now.
Yeah, I mean, Amazon just came out and said that they're going to start putting the tariff prices on all their goods, which 70% of which are imported from China. So I think a lot of that pressure he's going to feel in the near future.
Yeah, there was also an article that came out, I think this was last week, and it showed that Apple was looking to move their production from China to India. And I don't know if this was substantiated at this point in time, but I think that begs the question. It's like, is moving production from China to India going to solve the problem? Because yes, that solves our trade war with China. Or are we just kind of passing the buck down the line, and now we're going to have all of this production issues coming from a different country, and it's still not bringing it back to the U.S.?
Well, not to mention how many years it's going to take to move it there.
Correct. Exactly.
Yeah.
And I'll tell you what, this is why I love the financial markets, right? It's so hard to game the markets. I mean, you think, okay, so tariffs are inflationary, right? Because everything's going to cost more, at least temporarily in the short term. Well, then why are interest rates going down? Why is the bond market rallying so hard if inflation is eminently, going to go up? If the U.S. has we have all the cards. Why is the U.S. market underperforming all the other markets around the world, right? Why is the dollar dropping versus the yen and other currencies? So it's so hard to game the markets, knowing, even if you read every single thing and you listen to every little utterance from, the administration, it's so difficult to be a smart investor.
Well, it's the great irony of investing, right? It's all this American first policy. Well, it doesn't really feel like America first right now. Like to your point, Bob, with the dollar dropping, our stock market's taken a pretty big hit over the course of the last couple of weeks. And again, like the most shocking thing to me is Europe's at an all-time record high. Nobody liked Europe. It is in our portfolio for the record. But you couldn't find a strategist on Wall Street that could say anything good about Europe because their economies grow slower. They're more bureaucratic. But, they trade a lot cheaper, and we know right now their governments are actually stimulating their economies to offset the fact that they're concerned about tariffs here in the U.S. So it's like these unintended consequences. I find it so fascinating. And this is why, with a portfolio, why we design portfolios in a way where we never anticipate anything. We just always own international because, we don't know the magic day that international is going to do well. We couldn't have predicted it, but it's in our portfolio.
Well, it just seems like everybody, our clients included, seem to know what's going to happen in the future except us, which makes our job so hard. I mean, 5 years ago, a lot of my clients were like, well, why do we need to own anything overseas? America is the place to be. And I agree. I mean, I think America is a great place to be, but it's like, why take that chance? Because no one realizes, to your point, that there's these unintended consequences.
And especially right now, what's happened is all of these big technology companies have become a really large portion of the S&P 500, right? It's over 30% is just these 7 companies. And these big multinational companies are the ones who are at risk of tariffs. And that's why you're seeing things like the NASDAQ, the S&P 500, the Dow Jones are down much more than the broader markets because it's those few companies that are getting hit a lot harder. So if you own those, you're going to feel this a lot more than if you own the entire world.
Oh, yeah. We're going to talk about this later on the show today, but this over concentration in the American exceptionalism trade is just unbelievable. And I think you could get a big rebound in all those stocks. Don't get me wrong here. But this is why you don't want to put all your eggs in one basket, right? This is like textbook because whatever does the best in an extreme way, typically when it goes the other way, it goes the other way in an extreme way too. Just going back to my favorite line, you live by the sword, you die by the sword.
Yeah, but even a simpler way to look at it, you see a lot of folks that obviously get upset when the market swings 5% a day in one direction or the other. Volatility is very unsettling. But, to have all your money all or none in, all or none in the treasury, all or none in the stock market, all or none in the bond market, if you look at it from a valuation standpoint or just an upside potential standpoint, don't have all your money in bonds. I mean, you get a 4%, maybe get 4% in the treasury, right? Treasury yields are coming down. But you can invest in real estate right now and get a 4% dividend and have upside. You could buy our pipeline index and get 4.5% income and get upside. You can buy international stocks with a 3.5% dividend and have upside, have total return of close to 10%. But it's so hard for folks to see that because all they see is, a bond comes due, stocks are volatile, I can't handle the risk.
Or vice versa, right? They just can't handle not being or putting all their money in the shiny object of the moment, right? Whatever's going up at some astronomical level, not thinking that the other side of that equation is you can have astronomical downside. And that's exactly what you're starting to experience here in the markets over the last couple of weeks.
Yeah, and speaking of shiny objects, and we'll talk about this later in the podcast, gold is doing so well this year, but historically it's a terrible investment, but now that's all anybody could talk about.
Well, the short term kind of skews everything, right? And I think, Bob, you talked about this a lot, is, we all invest based on our most recent experience. And, specifically gold, right? Gold's just had such a massive move in the short term. It actually makes their longer term numbers look pretty good too. But if you go to the long term, gold really doesn't do much. And I think that's the hard part to see. Well, it's like, look at the 10-year track record or the 15-year track record. We know when it comes to investing, that's not long enough. And eventually, no matter whatever outperformance you're seeing over what the long-term average is, eventually the mean reversion is going to happen. And that's what I think people forget, is everything goes back to what averages eventually.
Well, for years, I've always observed that when does a stock or when does a segment of the market stop going up? Well, it stops going up when everybody already owns it, right? There's no greater fool to sell it to. So we had that international investor on our podcast, months ago, and he's trying to find these unique niche companies, companies in these small countries, and all they could talk about is having all their sovereign wealth invested in the Mag 7. So when you have every corner of the world invested in the same investment, what could go wrong? So it's so important to make sure that you're fully diversified, truly be diversified, because that's the only way to hedge against uncertainty. Always has been, always will be.
Yeah, and the big question with the tariffs, the reason I think people are concerned about it is there's the inflation question, but also could this put us into a recession? That's, I think, what people are worried about right now is companies going to have to do layoffs? Are consumers going to stop spending? And I'm getting a lot of people saying, if a recession happens, what should I change my portfolio? Are you getting out now? And I think this is something you need to remember with the markets, the markets are always going to react before the economy, right? So markets tend to bottom before the economy goes down. They tend to recover before the economy gets better. They're two separate conversations of is the economy going into recession or what should I do with my stock market investments? They're not going to work in tandem. And I think that's something people need to understand.
Oh yeah, for sure. And I think, one of the reasons we're seeing recovery right now is what the market's telling you is some way, somehow, these tariffs are going to get negotiated, right? That's a positive. There is going to be clarity down the line. And that should show up positively in the economy later, to your point, Courtney. So, right, it's like are
we going to be talking about this in 12 months from now? That's the question. That's what the markets are trying to figure out.
Yeah. Well, the other thing, too, going back to what Bob just said, is just how everything is interconnected, right? And then one of the reasons why the dollar just got hammered is what you were saying, Bob, is like all these international investors own the Magnificent Seven too. So when it down, what do? They panic sold out of it. Then they converted the money back to their currency, which pushed the dollar down. So it's like all these things are like a domino effect and they're all interconnected. And that's when you look at your portfolio, you want to make sure that you have investments that are that aren't connected. Or disconnected, we can say, like international right now, commodities. I think real estate's up for the year. Because if it's all interconnected to the same trade, you get that domino effect. That's where you feel like that max pain in your portfolio. And that's what we see with so many portfolios today.
Yeah, I mean, that's a good point, Rye. Like, if you have everything in the same place, whereas like having a diversified portfolio, there's nowhere to leverage the opportunity. If you don't own international, you can't take profits from there and buy into something while it's down. I mean, it just really puts you into a hole, and you just have to sit there and wait and hope that it comes back up.
But what if it doesn't, Bob?
Well, what if it doesn't? That means the world doesn't end very often. Maybe this time it does. So missiles are already flying. What's the difference? The results are going to be the same. But your point about everything being interconnected, you also have currencies, right? The dollar's down 10%. And if you're wondering why our international investments are outperforming right now, is because of the currency, right? If when you have a currency shift, it makes other assets worth more. And you think it's hard to predict interest rates? You should try predicting currencies. That's why you got to stay fully invested in the strategy that keeps you invested.
Yeah, and I said this before, but it's like the strategy that anticipates what's going to happen next is a bad strategy, because what if what you anticipate doesn't happen? So I think, or being able to anticipate any scenario is the right strategy, because things are going to change. They're going to change unexpectedly. So you already have to have a portfolio in place that anticipates that. To your point, Courtney, is there going to be a recession? Is there going to be no recession? Well, either way, have something in your portfolio that's going to work.
Exactly. And the markets are always going to move on the things we can't predict. The known unknowns, the markets have already priced in, right? It's that other black swan event. That's what's going to move the markets, which none of us can predict. And that's why you have to be positioned to be able to take advantage of things when they happen, as opposed to try to predict them, because that's just a losing battle.
Yeah, like be humble enough to know you don't know, right? I think that's it. I think, not knowing is probably the smartest strategy, knowing that you can't predict it ahead of time. And I think that's where investors get it wrong, is they want to know that they've got that little edge, that they can figure something out that the rest of us can't figure out. And we know that's not true. It's just virtually impossible. We just know that expect the unexpected. I mean, when you get down to it, it's that simple.
Well, then how come Chris and I are always getting clients calling us saying that, well, the market's going to do this now because now we have a Trump put. The market can't go down much further because Trump's in there. We're going to have the golden age, or Trump's in there and he's going to destroy the country, so the market's going to go straight down. Doesn't stop people from trying to predict what's unpredictable or what's unknowable. But all you have to do is look at what happened when these tariffs were announced. We had this extreme drop in the market. All right, the S&P went all the way down to 4,800. We're at 5,500 right now. It's like a 4,000 point move in the Dow. I think the surprise factor of tariffs is already priced in. And as you say, Court, what's the next black swan? What's that unknown that we can't anticipate? And truly, no one can anticipate it.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. It's the tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And today we are going to do a financial autopsy. One, Courtney, that you worked on, talking about a case. This individual came to you. They had a portfolio that had a lot of what we would call overlap. So that we could talk a little bit about some of the mistakes this individual was making with their money, how you fixed it, and just get into the nitty gritty. Hence, our financial autopsy.
Yes. And there was a couple of things that really stood out to me when this individual came to me. Number one is their investments were not efficient at all. And I say that from kind of across the board. They were not tax efficient. They also had a lot of overlap. So if you actually look, we do what's called a stock intersection report. And their top holding was Apple. And I see this all the time, right? It's going to be Apple or Google. It's one of the big ones. They had 19 different funds that all owned Apple, and they owned Apple stock.
That's 19 different funds. Yeah. And the best thing is all these funds have different names. So like if this is my portfolio and I think I have 19 different funds, I think my feeling is, man, I got to be so diversified, right? Maybe I'm too diversified with 19 funds. And meanwhile, when you look under the hood, they all own the same stocks.
Wait, are you telling me that there's a difference between the Vanguard S&P 500 fund and the BlackRock S&P 500 fund?
It's just how you feel when you open your statement.
And it's not even like that obvious. Like, it's not just like, oh, the Vanguard S&P, the BlackRock S&P. They all have these different names. Like, you might get the like large cap growth fund, the aggressive growth fund, they all have fancy names to them, but you really got to break them under the hood because they all own the same things. And this is very common. Like, I don't fault this client for this at all. They have no idea. This is why we do this for a living. We break this out so to actually show them, because they really had no idea how much overlap they really had.
Well, and the best part is, it's like, I mean, this is not unusual. I mean, we see this all the time when we're looking at people's portfolios. But, the funny thing is, I mean, they could have just owned Apple rather than pay, an internal cost for all these different funds.
Well, they did own Apple, but they thought that maybe that's all they owned, right? They had no idea all this other Apple on top of the Apple that they owned for free that they did for themselves. Exactly.
Well, Chris, that assumes that anyone can go back in time and say, oh, this is going to be the best performing stock in the next 10 years. I mean, the greatest stock picker in the universe, Warren Buffett, doesn't even do that, right? He owns hundreds and hundreds of companies. He doesn't put it all in one stock. So you have to be lucky, not smart, for that strategy.
Well, that's the problem here too, is you look at the top 5 holdings. It's Microsoft, Amazon, they own these outright, NVIDIA, Google. And then again, you go, oh, and Broadcom. There you go. So these are all the top names in the S&P 500. So they own them outright. Where again, you could just bought the S&P 500, and then they own them in 19 different funds. So it's like Bob likes to call it, it's the overlap of the overlap. Even worse, when the market sold off over the last couple of weeks, what got hit the hardest? Your Magnificent Seven stocks. And I think this is what most portfolios look like right now, right? It's like I have lots of funds. And hey, on top of it, maybe I'll buy a little Apple. I'll buy a little Amazon. And then in addition to that, they have like 20 different funds that all have the same names in there. And this is why you live by the sword, you die by the sword. And I think most people didn't even realize the risk that they had going into this volatility.
And what's interesting too is they own a lot of these in mutual funds. And the problem with mutual funds is the underlying manager is going to trade stocks underneath that, and it's really out of your say. And so you can have a year where you're actually paying capital gains taxes because they are trading out of these funds, even though you didn't decide to sell anything. And these were all in taxable accounts. And we've seen this over time. Actually, 2022, this happened where the markets were down, but everyone had these large capital gains taxes on their mutual funds because halfway through the year, the fund manager sold them. So whereas our clients right now, when things are down, you can do tax swaps, you can book losses, you might push off your gains if you have other income in a certain year. You don't have that say with these funds. So this is where if you're going to own them, at least on outright or an ETF where you don't have these tax issues, which they didn't realize was a problem in this case.
Well, that's totally insult to injury. When you buy a fund and it goes straight down and then your tax bill and you owe tons of money for something, all you've done is lose money. I mean, it's just, oh, what a horrible situation. I can't believe mutual funds still exist.
No, that's the thing. Like, yeah, why would you ever own a mutual fund nowadays, especially with the exchange traded fund is a much better model. I get it, Bob. It's the early 90s. It's your only option, right? You're the star at your Merrill Lynch office with the corner office, and all you can buy are mutual funds. That's understandable, but now ETFs are that's the name of the game. And from a tax perspective, right, you don't have unexpected taxes, especially in a year when you lost money. That just sucks.
Yeah, and Courtney, I'm curious. Did you present this to this person before the market really pulled back or after?
After, yes.
And what was their reaction to your findings?
I think they had an idea because I think they were seeing the markets go down and they were seeing their accounts go down with them, which I think some people were expecting, right? They say, okay, I'm in the markets, I'm down, the markets are down. Whereas if you're well diversified, like we have our portfolio set up, most of our clients have been really surprised because they're saying, oh, the markets are down a ton. And then they look at their accounts, they're like, oh, we're barely down, if at all. So I don't think they were surprised, but didn't realize how insulated they would be if they weren't just in these top holdings.
It goes back to a lot of stuff we talk about on this podcast is that you could have a great company, but it's not a great stock. So, a lot of these Mag 7s are great companies. Nothing's really changed except the PE ratio that people are willing to pay for that growth has shrunk dramatically. So you're sitting there doing all this analysis. You think you're, the smartest person in the room, and the market is very difficult, right? It's very difficult to know if you're buying a high quality company and paying the right price for it. Because, if you're an economist right now, you don't buy anything but US, right? If you're an investor right now, you're buying non-US because the valuations are cheaper, dividends are higher. And so far, the performance has been a lot better.
Well, I think it's simple. It's just that simple, Bob. It's just about concentrated risk, right? The whole idea is when you have quote unquote diversification, very overused term. It's just like when the U.S. stock market's going down, there's something else in your portfolio going up. And to your point right now, like I wouldn't have guessed at the beginning of the year that international stocks would be Europe of all places would be the best place to be. But that's dramatically outperforming every other market in the world right now, and it's a great diversifier in your portfolio.
If you guys go back to my training days back at Old Mother Merrill, my seminar, I used to name it, why isn't everybody rich was the question as you go through financial planning and investing. And this is the big reason. Chris, how many prospective clients have we spoken to in the last 2 years? This is their portfolio, right? They're overweighted, and it's like, well, Chris, you're a traditional investment advisor. You don't get it. This is the new world. And then when you call them back, they go, well, I can't reposition now. I'm way down. I got to wait till I get even. Meanwhile, the market moves on, right? Time moves on. Markets operate. Doesn't care how you feel, what you think, or they don't even care about your cost basis. And this is why most investors underperform. It's that simple.
Yeah, well, it's like the scariest words I hear from clients is when they talk about their portfolios. You talk about the risk, especially being so concentrated in these areas. They say things like, well, I'm comfortable with that. And they're comfortable until the market goes down 25%.
Yeah, exactly. Everything's is comfortable until all of a sudden, oh, wow, overnight, your portfolio is down 20%. Because of some unexpected tariffs.
Kind of reminds me of like a tornado out in the Midwest. They've got no way of predicting these things, and 5 minutes later, your house is gone.
That reminds me of Court. You had a client years and years ago who wanted to put 25,000 in some IPO, some roll of the dice, and you obviously discouraged that investor. Then they finally did. And they said, "What's worse going to happen, Court? I'll lose 25,000." Right? They immediately dropped it in half and go, oh my God, I've lost half my money. And I was like, well, what happened to, it didn't matter. Like 25,000 was no big deal. All of a sudden, people change their perspective when it doesn't go in the direction they like it to.
It almost reminds me of some of the more illiquid type of investments that were bought right before the financial crisis. And I think a lot of investors don't realize that when liquidity dries up, these more private type funds where there's not as much activity, they get hit the hardest.
Right, illiquidity, absolutely. The worst thing you'd have in a portfolio. I despise illiquidity because, the key to successful investing is buying low, right? And what do people do when things become volatile like they did over the last couple of weeks, right? They put their head in the sand, or they don't open their statement, or they don't answer the phone, or they call in panic. Where the fact of the matter is, it's the gifts from the gods, as you always say, right? It's an opportunity to buy low. Now, the problem with an illiquid investment, you have these gates that they set up where you can take maybe 5% out every quarter. So, yeah, all right, hey, give me my 5% because I'm going to take advantage of the dip that happened in the market. And by the time you get your money, the market's already recovered. You lose that opportunity, to rebalance, to do tax swaps, to make your portfolio tax efficient. But more importantly, that's where you get the extra return, right? I always say your big returns come in bear markets. And bear markets are short-term corrections. You don't take advantage of them. You snooze, you lose.
All right, it's the hidden facts of finance. Random financial facts that may surprise you or even shock you. All right, Bob, I'm not going to lie. This stat is really going to shock you today, so buckle up, buddy. A recent study found that fees can consume up to 26% of all the capital that investors commit in private funds. Private funds like private equity and hedge funds often charge high fees, shocking, including management fees and incentive fees. These fees can be a significant expense for investors, particularly when considering the overall returns on their investments, which last time I looked can be pretty lackluster.
Well, as you guys know, I used to have blonde hair and I turned prematurely gray. Reading those prospectuses and look at those expense ratios, which I don't understand why everybody doesn't start right there. Start with the expense ratios and then the risk factors. So you got something that 26% of the costs are going to go to somebody other than you and your family. And you have an investment where the downside risk is you could lose all of your money. it's just hard to believe that anybody's putting a dime into these funds.
Well, two things on that. First off, if you squint, you actually do look a little blonde, but you really have to squint. But secondly, when it comes to these funds, what amazes me is they're being sold like hotcakes right now. We talked about in our autopsy today, someone owned one of these funds. But it's like this was back in 08 and 09 during the financial crisis. You had so many of these hedge funds that were illiquid, high cost, high fees, and they got hammered. But it just seems like Wall Street continually resells the BS that they sold years ago that got destroyed. And people are just eating it up right now. And that just blows my mind.
Well, let's face it, guys. This is historically an institutional investment, right? This is for the really big money. And all I read is an article day after day about how the real big money is sitting there at the gate praying to get out of these things. Of course, they're calling retail clients now. They have no one left in the big money arena to sell these things to.
If they're for you, Mr. High Net Worth Investor, because you're special. All right, Chris. Resist fleeing stocks for gold. The surprisingly long outperformance of gold is mostly a function of its recent run-up, or what we call recency bias. From 1975 through last year, $1 in gold turned into $16 versus $1 in stocks turned into $348. Clearly, over the long term, gold really doesn't glitter.
It's a lot of glitter, but it's not so much growth. And you adjust it for inflation, gold has not historically been a great investment, but it has been going up recently, and people are definitely chasing those dollars, so it makes the long-term performance look a lot better than it actually is.
I'm not going to lie, though. If you had gold in those shoes, I would think differently. I would go out and start buying some gold bars. Actually, that might be the sign that this is overvalued when you can start buying gold bars at Walmart. Like, that has to be a sign that
I think they sell them at Costco, right?
I meant Costco. Walmart, Costco. I live in New York. What's the difference?
I've moved to the suburbs. Yeah, I'm back to Costco again.
Courtney now knows. Yeah.
It is a good diversifier, though, right? I mean, as much as we talk about it's not a good long-term investment, it is something we have in our portfolio that clients have complained about for the last decade and now are very happy this year that they have that because they're holding up a lot better because you have a portion of it. Don't put all your money in gold bars, but have it as a diversifier.
Yeah, and we own in a commodities portfolio and a lot of other great commodities too. So, we're not putting all of our eggs in one basket. Plus, it doesn't pay a dividend.
That's right. And Bob loves dividends.
Chris, don't you remember Ryan watching all those Austin Power movies, running around the house saying, I love gold. I love gold.
Ryan is wearing gold sneakers today.
I think wasn't that a week ago when I was All right. Courtney, in 2024, China's car exports surged by 23%, reaching 6.4 million vehicles, exceeding Japan's exports by over 50%. This signifies a significant increase in China's global auto market share. That's actually kind of scary when you think about it. We don't hear about it here because we don't see a Chinese car, but they are dominating in so many different industries now, like more like maybe higher end manufactured goods. And I think this is a real big risk.
Yeah, and I think this gets lost in the conversation with tariffs, where everybody knows that the auto industry is very exposed to tariffs. And there's this conversation of we need to lower our tariffs with Europe and get our cars sold there. But everyone kind of forgets about the Chinese market. Like, think about Tesla, which is a big conversation topic. Their biggest competitor is China. BYD is a company that really they're starting to outperform in the amount of vehicles that are produced. And that, I think, is going to be the big question over time is what's happening with the Chinese vehicle industry.
Well, yeah, here's the bigger question. Okay, maybe they take the tariffs on our automobiles, but let's face it, like, is a Ford really a good car? Are people really going to want a Ford if it's like 10% or 15% cheaper in Europe? I doubt it.
I mean, I like my Fords. I drove a Mustang when I was younger. But it is funny. They were talking about this recently, the fact we make bigger vehicles. Like in the US, you want like your SUVs, your trucks. If you go to Europe, they have these like small little cars that are really energy efficient. That's not what we make here in the US, which is kind of interesting.
Oh yeah, try to park one of those in a French parking lot.
Oh, my
like
goodness,
an F-150 would never happen. Like everything's miniature in
Yes.
Europe. It's the antithesis of Texas.
Yeah.
Hey, hope you enjoyed episode 202. Wow. Payne Points of Wealth. If you like our podcast, you love our podcast, please give us that 5-star rating on iTunes, on Spotify. If this is on YouTube right now, you can like this episode, subscribe to our channel, click that notification bell to be updated on all of our new content. Your support gives us the support to continue to do this podcast, so please don't keep us a secret. Spread the good word. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.